Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. So, what is velocity banking? All it is throwing all your money into debt with the help of something called a line of credit. And I was just asking ChatGPT here, what's the deal with replacing a 3% mortgage with the first lien HELOC? Because I've seen this promoted in other velocity banking channels, but basically, it ChatGPT says replacing a 3% mortgage with a first lien HELOC for velocity banking is trash because you're trading a low fixed debt for high variable debt. Interest costs go up, not down. Your home is more at risk. It's a marketing gimmick wrapped in bad math. Um, Keep your 3% mortgage. Don't get seduced by the velocity banking pitch. And so what we're gonna do is just calculate today the difference between doing a first lien HELOC and what they call a second lien HELOC, right? So I kind of already did this in a live stream earlier, but let's go ahead and do it again. Okay, we're gonna do it one more time, and I'm gonna restart from the beginning, from the very beginning, right? And so this is what we're gonna do. First step to doing velocity banking is the budget. So if you were in this situation right here where you made really good money, 11 grand a month, and you have 11 grand in expenses, and you have $0 left over savings because you have so much debt, then your first lien HELOC was the only choice you have, and you couldn't get a second lien HELOC, might consider it, right? Like, so if this was your only choice, might be um an okay idea, but I won't say this is like the best idea ever. Okay. So here you see 10 credit cards, and we have our non-debt operating expenses for $3,000 a month. And what we're going to do is we're going to first do a comparison of the first lien and then the second lien HELOC. So what does the first lien mean? It means you're replacing all your debt, including the mortgage, right, with a line of credit. And so think of it as a giant debt transfer into a credit card in a way, a very big credit card tied to your house. That's what a first lien HELOC is. And you see this promoted in many velocity banking channels. And in fact, if you know how to do this right, a 30% credit card will actually beat an 8% first lien HELOC if you know what you're doing. Okay. So this is what we're going to do. We're going to do a quick comparison of this. And let's actually go ahead and calculate the debt. So how much is it? It's 5, 8, 15, 27, 30, 7, 10, 35, 12, 18, 30, 45, 400. And I'm going to go ahead and sum this up. And this is $642,000 of debt, right? Because all we're doing is just taking the statement balances, adding them up. And so let's say, we had such huge um, equity that we're able to get a $700,000 line of credit, but it's not a free and clear line of credit. We're just transferring all of this, which would be 642,000. So we're essentially replacing the mortgage and all of our debt. Well, when we do velocity banking, so the whole idea is to maximize your cash flow, but we have to do it the right way. But this is what you'll see a lot in other velocity banking channels. So here's the deal: you don't really save money, and you're going to increase this thing called cash flow. And so when you move all the debt, right? So it's going to be 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, except for your general expenses, which we also call our operating expenses in the business world. We're going to look like we have $8,000 of cash flow, but we need to factor in the cost of using the line of credit. Okay. And so because we're have an 8% line of credit, right? And the line of credit is based on the average daily balance. Okay, so let's go ahead and get the next month's balance, which is based on the previous month's balance and interest minus our cash flow. Okay, and the line of credit is going to be calculated on the average daily balance, which is 0.08 divided by 12. Look at this, $4,000 of interest. So again, we are positive, but not as positive as much as we think. And let's go ahead and do the math, right? Now all we gotta do is copy and paste. So you do see the debt going down, but let's just calculate how long it's going to take to pay off that debt. Okay, and did I do this right? So see right here, Okay, so this is going to take 114 months. Let me go ahead and highlight that right there. So it's going to be 0, and then I'm going to sum it up. So you see that's 270,000 at 114 months, okay? 270,000 of interest. So we're going to go ahead and calculate that. So first lien HELOC, second lien. Um, and why am I so confident in this? Because I've done this a gajillion times already. And I did a live stream on it today too. 99 cents, members only, YouTube channel. You should just check it out just for the 22 debt payoff that I did. That was a real life case study. So 114 months, 270K. So 114 months, 270K. Okay. All right. So we're going to do that. And then, all right. So we got that covered. And then what's the next step? So I'm going to just do the next step right here. Whoopsie. What am I doing? Okay. So that's been paid off. And then now what we're going to do is pay off the next. Actually, all the debt is paid off, right? So now what we have to do is now compare it to what we call second lien HELOC, meaning the mortgage is in place and we're paying off the debt strategically. And the easiest way to figure out what debts to pay off strategically is by using what we call the cash flow index. So what's the cash flow index? Well, basically you get the statement balance. So let's say $5,000 and you divide by the monthly payment, and then it gives you this arbitrary number right here, right? And so it's like a ranking system. And so what does it mean? Basically, like how much bang for your buck do you get for paying off the loan? So for example, if I pay this $30,000 here, I get about $1,000 back in my cash flow. Whereas if I pay the $400,000, again, this very high number means that I only get a little bit of cash flow relative to the amount of debt that I pay off, right? So that's why we want to maximize our cash flow by paying off the little as little debt as possible. And we're going to do it with all of these numbers right here. Okay. And so let me just kind of restart this. And so luckily we don't need a 600 or $700,000 line of credit for this, right? We could just start off with maybe a $170,000 line of credit. And then if we go ahead and do this 5, 8, 15, 27, 30, 7, 10, 35, 12, 18, and sum them up, that's $167,000 of credit card debt, right? $167,000 of credit card debt. I'm going to do this right here, right? And then what's our cash flow right now? Well, let's just check. So we just got to get rid of the credit card debt only. That's what we're starting off with. And one of the most important things that I never really hear talked about is how important debt payoff order is. Okay. So let's go ahead and do the credit cards first. And then I'm going to just do this right now. And this is going to be 5.8345.83. And let's see how long it takes us to pay off the credit cards. So this is going to be 35 months, right? So 35 months, we'll say this is 0. And how much interest is it? That's about 20.1K, all right? So let's go ahead and do that. So 35 months, 20.1K of interest, right? And so let's go ahead and do that one more time and blah, 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 blah. Okay, so 20.1K. And then, I don't even know what I'm talking about. I'm so sleepy. Actually, did anybody else watch the Mission Impossible movie? I watched it at 9:40. I was like, this movie is so long. And then when I left the movie theater, it was like 1 a.m. I was like, what happened? I literally had no idea what was going on in that movie. And I think that happens to me in every Mission Impossible movie, but it was seriously happening in this movie where it's like, what is going on? And it was like just this giant exposition dump. It's like, and I was like, what? And then it made absolutely no sense to me. I love Top Gun Maverick though. Like if you choose like ask me like choose what's Tom Cruise's latest best movie, it definitely is Top Gun Maverick. Not a big fan of Mission Impossible, even though I do, love the cool stunts and stuff. But I feel like Top Gun Maverick had more heart. All right. Anyways, so let's go ahead and which one is this? This is the credit card. Yeah, this is the credit cards. So now we're gonna move on to the next loan, and luckily we have this loan calculator sheet to kind of determine which loan should we pay off. And then if we type in the current month, again, we get that cash flow index. We take the lowest one. Again, what does this mean? We pay 13 grand, we pay $552, or we get $552 in our cash flow. If we focus on this one, the 33 grand, we get $466 in our cash flow. So let's go ahead and move this 13 grand here. And then I'm just going to add this right here. So plus 13231.4, right? So this is where we start paying. And I am going to get a 0 right here. And then so what's our new cash flow? It's about $5,898.33. And then we're going to do this. And I'm going to do 5898.33. And then, whoopsie, where did I go? Man, I must have, okay. And then this is going to be right here. And then I guess we could just calculate the interest up to here, right? So we do this. And $160 of interest. Okay, but it's also $160 plus the amount of interest we paid so far. And then this will be J2 plus K2, $2,728.75. So we'll say about 2.7K, 2.73K. So for the car, that's going to be 2.733K. And then how many months of interest, or how many months? So it's going to be 38 months, right? 38 months. Okay. All right. And then now what's the next one? It's the student loan. All right. So this is going to be, we're going to be at month 38. 38. Okay. And so for this one, as we get to higher cash flow index numbers and we see a difference between the loan interest rate and the line interest rate, easiest way to pay it off is doing what we call the chunking method. And so what we do is, instead of just moving the whole thing into the loan, although with the student loan, I don't think it's going to make that big a difference, but you'll see when I talk about when it comes to mortgage, you just kind of pay it off in pieces with the line of credit. So we're just going to do this. We have this velocity banking calculator right here, provided by Renatus. So if you don't know what Renatus is, it's basically where I learned velocity banking and all this other cool stuff too. Click the Google form link below and pay me lots of money. I do get commission, yada, yada, yada. Actually, I'm really sleepy. All right, so 32869.23, 32869.23. And then this is going to be interest rate, so 4.5%. And what's the term? The term is 10 years, and then the payment is 466.37. So 466.37. This is our income, and then our expenses is everything except for the loan we're trying to pay off. So it should just be 4686.42. 4686.42. And then we'll do a $12,000 chunk amount, meaning we're only moving $12,000 into the line of credit. We're not moving the whole thing. Although if we move the whole thing, like 32 grand, it's not going to be a big deal. At least I don't think it will be. And then we'll say 8% interest. And then you'll see that it takes us half a year and $400 of interest. So let's go ahead and do that. So this is going to be so for the student loan, it's going to be 38 plus 6. So 38 plus 6 should be 44 months. And then the interest that we pay should be $415 plus the other interest that we accrue. So that's going to be 6 grand. Okay, 6 grand. So that'll be 6K of interest. You know, people, that's so fast. How did you do that? And I'm like, I'm Neo in the Matrix. I'm just kidding. No, here's the thing. You wanna know how you get good at this? You just study over and over again, which is what I did. A lot of people don't wanna do that. They don't wanna do that, okay? But whatever. I mean, I did pay off my mortgage in 2 years and 9 months, so just bragging, just bragging. It's not like anybody really cares, though. Anyways, what am I even talking about? Student loans, and now it's the mortgage, okay? And we just do the same thing here. So 40, so this is 0, and then this is 44 months, and then we just put in the details of the mortgage. So it's gonna be um this one, this is gonna be, I think, 3,000. So payment amount is 1686.42, I believe. 1686.42. And then the current balance is 368,116.01. So 368,116.01. And then I believe we started a $400,000 mortgage. So $400,000 mortgage, 400,000,30. And then the interest rate is 3%. Okay. So this is the part, and actually this is wrong. The expenses should probably be 3,000, right? Let me just quickly check. Yeah, it's 3,000 because it's everything except for the loan you're trying to pay off, and we're trying to pay off this loan, so it should be 3,000 now. 3,000. Okay. So I just do 3,000 here. And then you see that it pays off in 4.1 years. So I'm just going to show you something crazy that makes absolutely no sense. So for example, if I move this entire loan into the line of credit, you see that you pay 73 grand in interest, okay, compared to the 24 grand if you just do it in small chunks, okay? Now, here's the other thing what people don't understand, right? So let me just do this one more time. You see how this is 73K? 73K of interest first lien, right? And this is an 8% first lien HELOC, okay? Now, let's do this. We'll do $12,000 and then we'll do 30% chunks. Look at that. Look at that. This 30% credit card beat the first lien HELOC, 32 grand instead of 73. Isn't that crazy? Isn't that crazy? Now, obviously, you want the lowest interest rate possible. That's why we'll get the 8%. But all I'm saying is this: even if you get a first lien HELOC at 8%, a 30% credit card when you use your chunky method will beat that. Like, you just pay little pieces at a time. Okay. Okay. So here's the thing. Okay. If it's 73,000 that I pay with the first lien HELOC, think about the difference. Um, how many, what's it called? Cyber trucks can you buy? And I did the calculation a little bit earlier, and I think it was like two and a half cyber trucks that we could buy by saving all the interest. But let me just do this right here. And so this is going to be 4.1 years plus 24.6 grand, 24.7 grand. All right. So let me just do this right here. So 24700. And then, so the amount of interest that we pay is actually 67K because we have to account for the interest that we paid as we're making the payments to our loan. And then, let me just kind of just do this right here. So this is going to be 67 grand, 67 grand. So that's the amount of mortgage that, or interest that we pay. And then this is going to be what, 44 plus 4.1 years. So let me do this to the math. 44 divided by 12.41. 7.77 years. Okay. 7.77 years, I think. Hopefully I'm doing the math right. All right. So, or actually, I need to reverse it. I need to do the years, okay, and then the interest. So let's calculate the interest. So that's going to be 20.1, 2.73, 67, and then in total, it would be 95K of interest, okay? So 95K of interest. So, and then here we have 270. So what's the difference between the first lien and the second lien? It's 174K of interest that you're overpaying on the first lien HELOC. And not only that, okay, so if we do 114 months divided by 12, that's 9.5 years. So 9.5 minus 7.77 is 1.73 years. So you pay it off earlier in 1.73 years if you use a second lien HELOC. So I actually did a comparison, and I think a Tesla Cybertruck, how much is a Tesla Cybertruck? Okay. Let me just do a quick search, or we'll just ChatGPT cost of Tesla Cybertruck. 72 grand. Okay, 72 grand. So let's go ahead and figure out how many Cybertrucks we could have paid by not doing the first lien HELOC. So 174 divided by 72. Ooh, that's 2.41, 2.42 if you round up. So that's why I have the two Cybertrucks here. Two Cybertrucks, and then we got the little 0.41 here. So I don't know about you. If you want to give 2.41 Cybertrucks to the bank, then yeah, do a first lien HELOC. But if you want to not pay that and, not pay the 474K, might as well do the second lien HELOC, right? Not replace the mortgage, and then yeah, do it that way, right? Again, I don't give financial advice. I'm just doing a comparison, and a lot of people like, well, I did a first lien HELOC, and it's like, all right, but you were at the end of the loan, so it doesn't really matter when you're at the end of the loan. But when you're in a situation where people are they're strapped because they have too much debt, and then they're thinking of doing some debt consolidation. Much easier just do the second lien. In fact, if the lender is in the second lien position, they have much more potential to get screwed than the first lien, right? First lien, if you foreclose, you always get your money, or you get the money back, but then the second lien holder doesn't, unless they pursue deficiency judgment. If you don't know what I mean by that, then good times. Okay. All right. So, as you can see, okay, for apples to apples, that when you do a first lien HELOC, at 8%, it'll actually do worse than a 30% credit card. Because 32 grand versus, oh, look at that. 32 grand versus 73 grand. You're literally paying double for that first lien 8% HELOC than just using a credit card. So I'm sorry, like, I don't know in what world where the 8% actually gets beaten by the 30% credit card, but this is the reality of what is being taught today. And the reason I make these videos is because you just keep seeing it over and over again. Upload videos telling you first lien HELOC is awesome. Like, all right, well, I don't agree with that, but it is what it is. And I got the Excel calculator to tell me that it ain't so. All right. Okay. Well, that's it for today, folks. Freelance and mentorship. Have a great day, and I'll see you all in the next video.